The most brutal financial truth is this: when you earn more money, you do not necessarily get to keep more money. You get taxed harder, billed harder, and priced out of your own life, while the people who own the system keep finding legal ways to keep score. And here is the part that makes people angry enough to stop watching, but also angry enough to keep listening. In 2026, the same mechanism that turned the middle class into renters is still working. It is not just about taxes, it is about where new money flows, who gets to borrow it, and who gets to write off the risk. This is not financial advice, this is financial education. If you want the kind of education that hurts at first and frees you later, stay with me. Let's start with a scene you will recognize even if your job title is different. Picture you earning $10,000 a month, feeling trapped but managing. You get a raise, your paycheck grows, you breathe for the first time in months. Then the next month arrives and you realize your life did not improve the way your brain expected it to. You are not imagining it. That gap has a name. It is the combo of wage taxes, payroll taxes, bracket effects, benefits phaseouts, sales taxes, and fees that quietly scale with your income. Then the real knife comes from housing and insurance, because your raise is often swallowed by higher rents, higher deductibles, and higher bills for services you never asked to pay more for. Now, in the United States, the United Kingdom, Canada, Australia, and much of Europe, people are getting hit from every angle at once. And the timing is not random. In 2022 and 2023, the Federal Reserve and other central banks raised interest rates aggressively to kill inflation. You were told it would cool prices and protect savings. Real inflation cooled later, sure, but the damage to purchasing power did not reverse. According to Federal Reserve data, average wages never fully caught up with the inflation surge that began in 2021. Your salary may look bigger on paper, but your grocery cart and your mortgage payment tell the real story. In 2026, AI is accelerating the squeeze too, not in the sci-fi way people worried about in 2020. It is more boring and more effective. AI is removing the middle layers of work, the routine analysis, the basic coding, the customer service scripts, the back office processing. Many people were told to learn to code as if knowledge was a shield. In 2026, AI codes better than most humans, writes customer emails instantly, drafts product listings, and automates parts of compliance. So you get trapped in a job market where the path to higher income is slower, while the path to higher costs is faster. And that is where taxes enter the story in the cruelest way, because taxes are not just about funding government. Taxes shape incentives. They decide who can turn profits into growth and who must turn profits into survival. Here is the first uncomfortable question: why does it feel like the people who are already struggling pay a bigger percentage of what they have left? Think about the logic your life taught you. You work hard, you earn more, the world rewards you. That is the bedtime story. But the system is designed to reward ownership, not effort. In many countries, the tax experience of a typical worker is a treadmill. You earn more, you hit a higher bracket, you lose credits or deductions, you pay more payroll taxes, and then you get help that slowly evaporates. Meanwhile, your spending expands too, because your landlord and your insurance company notice your income has risen. Now compare that with how wealth works. Wealth does not increase only through wages. Wealth increases through assets, stocks, bonds, businesses, real estate, intellectual property, and the legal structures that manage taxes and risk. So let's talk about the biggest lie in personal finance education. The lie is that you can escape the system by being disciplined. Save more, invest more, cut spending. Those habits can help you survive, but they will not fix the core math that decides who gets to compound and who gets to tread water, because the real engine is not your personal behavior. The engine is capital formation, credit access, and legal tax treatment. And in 2026, credit access is shaped by a simple fact: banks and large financial institutions do not lend equally to everyone. They lend to the people who can protect the bank's downside. So the next question is even uglier. If new money is being created in the economy, why don't you see it? You hear about money printing, money supply, stimulus, quantitative easing, rate cuts, and so on. You hear that the government is injecting liquidity into markets, but your life does not feel liquid. Here is what is really happening in plain language. When central banks expand balance sheets or keep policy loose at the wrong times, that money does not land evenly on your doorstep. It enters through financial plumbing: banks, asset markets, broker-dealers, corporate credit, and institutional channels. The people closest to the plumbing are the ones who convert that liquidity into asset prices. Asset prices go up first, wages go up later. Sometimes wages never fully catch up at all. If you lived through the last decade, you already know the pattern. Housing detached from wages, rent pressure rose, insurance costs rose, climate-driven disruptions expanded the cost of living. Even where inflation came down on paper, real purchasing power stayed bruised because essentials, food, housing, healthcare, insurance did not fall back to previous levels. According to multiple labor and consumer surveys, the average worker experienced a persistent gap between wage growth and cost of living growth after 2020. So, where does the money go? It goes into financial assets first. It goes into stock buybacks. It goes into corporate refinancing at cheap rates when they were available. It goes into capital gain strategies that reduce taxes. It goes into real estate acquisitions by people with leverage and relationships. And when you try to buy a home with a paycheck, you are competing with people who do not need to wait for cash the way you do. They borrow, they structure, they offset, they defer. You are not competing with other buyers. You are competing with legal advantages and access to credit. Now here is where the conversation becomes dark in a very specific way. Taxes are only one part. The deeper mechanism is incentives around income recognition, expense deduction, depreciation, and leverage. Let me give you an example you can actually feel. A typical worker makes $10,000 and pays a portion in taxes. Let's say your effective tax rate in that year is 5% at first, then increases as you move to the next income level. Your paycheck grows, but the percentage you keep may not, and your costs rise too. That means the actual lifestyle you can afford barely improves. But now switch the story to a business owner. The business owner can often convert personal spending into business expenses. The business owner can use depreciation rules for equipment and property. The business owner can borrow against the asset instead of realizing taxable income at the top of a bracket. The business owner can choose timing for recognition. This is not magic, it is accounting, and the system rewards people who understand it. At the extreme end, wealthy investors and major shareholders can build portfolios where a large portion of gains are taxed at favorable long-term capital rates, while wages are not the dominant income source. So the question is not whether the rich pay taxes, they pay taxes. The question is why the rich often pay less relative to their total wealth growth, and why the poor often pay more relative to what they can afford after bills. You can see this pattern in real-world reporting and tax policy analysis across the last 2 decades. The top income groups in many countries have benefited from capital gains rate structures, loopholes, deductions, and the ability to borrow against appreciating assets instead of selling them. Borrowing is not the same as realizing income, and in an economy where asset prices can rise, borrowing becomes a way to live off wealth without triggering the full tax bill immediately. In 2026, this becomes more intense because inflation and high interest rates make cash expensive and borrowing more strategic. If you can borrow at a lower rate than the expected growth of an asset, you can use leverage to keep accumulating. If you are stuck with wages only, you do not have that lever. And then the insurance and climate factor hits you, because the poor are far less able to absorb shocks. When insurers pull back from wildfire or flood zones, people are forced to relocate. Relocation costs are brutal. Your savings lose value, your credit takes hits. Meanwhile, wealthier households can choose safer areas, buy coverage in higher tiers, and spread risk across multiple properties. So while you are dealing with the human version of risk, the rich are dealing with risk using financial instruments. That is the difference. Now let's talk about the money flow you are not seeing. During times of monetary easing, governments and central banks expand liquidity. Many people imagine that means government hands you checks. But that is not how modern monetary policy works in practice. The liquidity enters through banks and asset markets. If rates are low or if the central bank signals support, institutions buy financial assets. They collect spreads, they earn interest, they refinance, they do deals. Then the asset values rise, the wealthy gain through ownership. The middle class gains slower, if at all, because they mostly own labor and a small amount of assets. And then when the cycle turns, the burden shifts. When inflation or rates rise, wages often lag. Debt payments rise, credit gets tighter. And you notice that your economic safety net behaves like a marketing slogan, not a guarantee. Pattern interrupt here, because this part is where people stop believing the story. In the United States, the share of total wealth held by the top 1% has increased across recent decades and remained highly concentrated. Multiple reports from wealth research groups show that the top tier owns a vastly disproportionate share of financial assets. That is not just inequality as an emotion, it is inequality as a math problem. If you own a portfolio that rises when money floods in, you build wealth. If you do not own that portfolio, you absorb higher costs and lower real purchasing power. And by 2026, AI is doing something else. It increases the speed at which the top can extract value from capital. Automation reduces labor cost for firms. If you are a shareholder, that can be good. If you are a wage earner, it can be devastating. So the disconnect widens. Now let's return to taxes and the two kinds of people idea, because it is not about stereotypes, it is about constraints. If you have no income, you obviously might not pay income tax in the usual sense, but you may still receive government assistance. If you have zero wealth and unstable income, it is also hard for the government to enforce collection. You are a low priority for enforcement because extracting money from you might be costly and inefficient. On the other side, if you have high income and high wealth, enforcement is not the real issue. The issue is structuring. The wealthy do not always hide their income in the literal sense. Often they use legitimate mechanisms to reduce taxable income and defer taxes through investments, asset-based borrowing, retirement accounts, business structures, and legal tax planning. So the poor do not always evade taxes, many cannot, and the wealthy often do not need to evade either. The laws they influence and the systems they navigate can create outcomes where their effective tax burden is much lower than you would guess by looking at their headline income. And here is where it gets truly ugly for you and me. Your life assumes that society redistributes money fairly, taxes collected from the rich fund public goods. That is the ideology. But your lived experience often looks like this. The rich get capital market support, the stock market becomes a wealth engine, and ordinary people get wage stagnation and higher costs. When social programs expand, who pays? Not some invisible other taxpayer. You pay. Everyone pays through payroll taxes, consumption taxes, higher fees, and debt service costs. Meanwhile, printed or created liquidity first flows into asset prices and into the balance sheets of large firms and financial intermediaries, and once it's in the pipeline, it is very hard for it to drip down to your rent account in a meaningful way. So what do you do if you want out of the trap? You could do the boring answer: increase income, save, invest. But in 2026, the trap is more advanced. It is not just about low savings, it is about how the system converts your incremental income into taxes and costs without giving you enough asset leverage to protect you. So you need a different strategy. You need a strategy that reduces your dependence on wage income as your main weapon. You need income streams where the machine runs even when you are not trading hours for dollars. And that sounds like the passive income dream people on social media sell you. It is also where most people get fooled, because passive income is often just a marketing word for you already have assets. In real life, building passive income requires either ownership or control of revenue-generating assets. That means you either invest in ownership, build a business, or create intellectual property that earns royalties. Let's break that down without selling fantasy. There is earning money with your hands. That is your labor. Cleaning, coding, driving, nursing, teaching, managing, selling. When you stop working, the income usually stops. If you get sick, you get punished. Then there is making money with money. That is investing, and investing through entities. It is not just buying stocks. It is understanding risk, diversification, and how taxes work around capital gains versus wages. It is also understanding that the best returns often require patience and the ability to hold through volatility. But there is a third layer that most people never reach, not because it's secret, but because it requires you to stop thinking like a worker. That layer is hard money. Hard money is not a magic currency. Hard money is money that is resilient because it is backed by assets, contracts, collateral, and institutions. It is money that can be financed, pledged, and leveraged. This is the kind of system wealth uses to outlast crises. Now let's make this concrete with a scenario you can visualize. Imagine you own shares in a growing company. If you need cash, you might think you simply sell some shares. But sales at the wrong time can trigger tax events and can reduce your bargaining power. If you own a large block, selling can even move the market price. So instead, wealthy owners often borrow against collateral. They pledge shares to a bank or broker, borrow cash at a rate tied to the collateral value, and keep control of the shares. If the shares drop in value, the lender can require additional collateral or can liquidate part of the position. That is why the loan-to-value ratio is often conservative. To you, this looks like a loophole. To the lender, it is risk management. To the owner, it is control. This is not criminal, it is finance. And it is one reason why asset owners can turn volatility into living expenses, while wage earners are forced to sell only when they are desperate. In 2026, with rates and credit costs still important, the ability to borrow against assets becomes even more powerful. If your net worth is mostly financial assets, the system can treat you as creditworthy. If your net worth is mostly labor, the system can treat you as replaceable. And now we loop back to housing, because housing is where you personally feel all of this. Housing affordability crises are not local, they are global. People in the United States face wage-to-price gaps that keep expanding. In the United Kingdom, long-time homeowners are protected by asset appreciation, while renters face rising costs and limited ability to save a deposit. In Canada and Australia, housing has behaved like a financial asset for decades, and policy often reinforces that behavior. So what happens? A generation ends up renting longer and longer. The middle class cannot accumulate equity fast enough. Meanwhile, institutional investors and wealthy buyers use leverage and access to financing. They buy in volume, they negotiate terms, they can wait out slow markets. So you are competing with entities that can borrow cheaply, that can distribute risk, and that can hold assets while you are forced to pay rent today. This is why the idea that if you work hard you will earn enough to buy a home eventually has become a cruel joke. It is also why your anxiety about AI replacing jobs is not just about employment. It is about your ability to build wealth when wages stop rising. If labor income is reduced by automation, and if housing prices keep rising faster than wages, then you can work harder and still lose ground. Now pattern interrupt again, because this is the part nobody wants to hear until it's too late. Most people treat taxes like a standalone issue. They argue about tax rates in headlines, and they ignore the pipeline. In reality, the pipeline is this. Central bank policy influences liquidity. Liquidity influences asset prices. Asset prices determine how much collateral people can borrow. Collateral determines how much cash can be extracted without selling. Extracted cash can be used for investments and lifestyle, and taxes determine how expensive it is to convert assets into income. So even if you never learn tax law, you must understand the mechanism. And the mechanism is designed to reinforce existing wealth. Now let's return to your question, the one you asked silently while scrolling at 2 in the morning. How do ordinary people become part of the top 20%? In the original story that inspired this idea, the advice sounded like a trick. Use a company structure so that expenses reduce taxable profit and ownership stays in the entity. You can hear how this becomes a game of categories. What counts as personal income versus business expense? In the real world, the details vary by country, but the principle holds. People who understand entity formation and expense deduction can reduce their immediate taxable income and reinvest more. But let's be honest and ruthless. Not everyone can or should form a company to game taxes. That is not empowerment. That is just another fantasy. Real empowerment is building capabilities that create scalable income. That usually comes from controlling distribution, owning a revenue-generating asset, or creating a system that produces value without constant labor hours. In 2026, AI makes this both easier and harder. Easier because software and automation lower the cost of production. Harder because competition is faster and cheaper. If everyone can build a basic website, then building a basic website is worthless. If everyone can produce AI content, then content alone is not enough. You need distribution, trust, brand, or a specialized offer that AI cannot commoditize instantly. So the practical question becomes, how do you create an income stream that is not tied to your personal availability? One path is ownership of businesses with revenue. Another path is investing with discipline and focusing on asset allocation over quick wins. Another path is acquiring intellectual property, licensing, royalties, or contracts that pay over time. And yes, in some cases, real estate can be one of the paths into leverage. But real estate in 2026 is not the same as real estate in 2019. The interest rate environment and insurance costs have changed the risk profile.